Google stock has been on a roller coaster in the last month. Before the company released their latest quarter's earnings, they were trading in the $140 range, and when the latest quarter's earnings released, they jumped all the way up into the $165 range. And the reason behind this is investors found out that Google search revenue increased 10% year over year. This was a huge deal because the underlying theme behind the bears was that AI was going to destroy Google search. So this was great news for people bullish on Google. But on the flip side of this, Google saw a huge sell-off just the other day. In fact, it sold off over 8% in a single day. And this came after searches in Apple's Safari browser, which has Google as its default search option, fell for the first time in April, something that has never happened in 20 years. Now, what's interesting is in the midst of this chaos, the financial publishing company Barrons released a very interesting article titled, "Google Will Survive AI and Break Up Calls: Why Alphabet Stock Could Gain 50%. And this article does a pretty decent job discussing some of the risks that Google stock is currently facing, but the most interesting part is down here at the end. At the end of the article, they state that Google's pieces could be worth $260 per share, more than 50% higher than Thursday's close. This is an interesting way of really seeing how each product or business segment is being valued by the market. And by doing this, we can actually get a better understanding of what Google stock is actually worth. Now, if you're not familiar with what's been going on with Google stock right now, if we look at this company in the last year, it's down about 11.67%. And at one point, this company was trading at over $205 per share. So really the sell-off in just the last few months has been pretty drastic. Now, what's interesting is if we look at the forward PE ratio for Google, it's now sitting at just 15.96, while the company's 5-year average is about 25.25. So it's trading at a valuation 36.78% lower than its historical multiple. What's the reason behind this? Well, the reason is people are scared about the threat of AI eroding Google search's moat. So the question we have to evaluate, and that's discussed in this article, is how does this impact Google's valuation? And what I've done is I've backwards engineered what's discussed in the article to see exactly how each segment within Google is currently being valued by the market. So we have Google Search, YouTube, Cloud, and then Waymo. So let's take a closer look to see what this article actually has to say about each of these business segments. They start out by talking about Google's cloud business, which they estimate could generate roughly $20 billion in 2025 earnings before interest, taxes, depreciation, and amortization, also known as EBITDA. What this means is this segment of the business could be worth $325 billion at a 16 times multiple, which would be similar to what Amazon and Microsoft fetch. So if we go ahead and zoom in, what we can do is we can look at the Google Cloud business segment. And what this article told us is they expect 2025 EBITDA estimate for Google Cloud to be about $20 billion. Now, they value this at a 16 times multiple, and the reason they stated is because that's pretty much the multiple that Microsoft and Amazon have their cloud business valued at. So with $20 billion estimate and a multiple of 16 times, this would give their cloud business segment a value of $320 billion. So the big question is, what would that per share value be? Well, all we would have to do is divide it by weighted average shares outstanding. And of course, using the ticker data add-on in Google Sheets, we can easily import this into our spreadsheet. I'll just use the equals ticker data function, select Google, come down here and select weighted average shares outstanding. And then we want it for 2025, and we want it for the most recent quarter, which was Q1, and I'll hit enter. And we can see the weighted average shares outstanding will automatically load into my spreadsheet, telling us that the per share value of Google Cloud Business is $26. Keep in mind, Google's currently being valued at about $155.75 per share. So now we have one business segment valued. Let's move on to YouTube. The article states that YouTube would be worth up to $800 billion if it traded at 22 times EBITDA, which is the average of what Meta and Netflix change hands for. This isn't a perfect comparison, but I do still think it's reasonable for the most part. So if YouTube's being valued at about $800 billion and it's trading at a 22 times multiple, that would mean the EBITDA estimate for 2025 is 36.3. So again, let's just copy and paste our shares outstanding. And what we can see is this would give YouTube a per share value of $64. So between the YouTube business segment and the Google Cloud business segment, Google has a value of about $90 per share. But then we have the wild card. We have Waymo, their self-driving service. And the article completely admits Waymo is pretty difficult to value at this time. I completely agree. Uber is currently valued at about $150 billion, while obviously valuations for Tesla's self-driving business can range anywhere from about $100 billion all the way up to trillions, even though the company has yet to complete a single fully autonomous ride. Meanwhile, Alphabet's Waymo completes 150,000 self-driving cab rides each week. The article claims it's reasonable to value it at about $300 billion, but it does make note some bulls think it's worth far more, with some estimates being between $350 billion to $850 billion by the year 2030. So let's go with the most conservative estimate that we saw there, $300 billion. Again, if we copy and paste our shares outstanding over, we can see that the per share value based off very conservative estimates for Waymo is about $24. So if we add these three values up together, it would give us a share value of about $114. Now, here's what's interesting about this. Again, using the ticker data function, we'll use the ticker data live function. We select Google and then state that we want the market cap. I'll hit enter. And we can see the market cap of Google right now is sitting at about $1.87 billion. Let's compare this to the total value based on YouTube, Cloud, and Waymo. I'll just use the sum function here in Google Sheets, and we'll sum these values here. What we can see is the value of these three business segments is about $1.42 billion. So what does this mean? Well, we can back into exactly how the market is currently valuing Google Search simply by taking this number and subtracting out this number. So let's go ahead and do that and see what the end result is. We can see the market is valuing Google Search at about $457 billion as of right now. So then if we look at this on a per share basis, we'll take this number and then just divide by the number of shares outstanding. We can see the market is valuing Google Search at a per share value of $37. Now the question is, what does this mean? What type of multiple are they trading at to be at $37 per share? And this is where things get really interesting. We can see at the time this article was written, they stated that this leaves Alphabet's search business worth roughly $550 billion. So this article was written before the recent sell-off. I know this because when we backed into this number, it was only valued at $457 billion. So the valuation of Google Search has gone down about $100 billion just in a matter of a few weeks. But at the time the value was $550 billion, this was an EBITDA multiple of just 5 times. And based off another estimate, he believes Google Search is trading at a multiple of just 11 times earnings. Now, if we take into account the fact that it's no longer being valued at $550 billion, it's actually being valued at $457 billion, it would mean all of those multiples are even lower. So after the sell-off, let's be conservative again and say Google Search is only trading at a multiple of about 10 times earnings. Let's put that into comparison of some other stocks. For example, let's look at Pepsi. Now for reference, I do completely understand these are completely different business models, so it's not a perfect comparison, but what I want to show you is how most companies are being valued with a price to earnings multiple based on their earnings growth projections. We can see Pepsi has a forward PE ratio of about 16.55. But what's interesting about this is if we look at growth estimates for Pepsi over the next few years, what we can see is the 3 to 5 year EPS growth rate is only projected to be 3.42%. Only 3.42%, that's very low. Yet despite this, like we just saw, they're trading at a forward price to earnings ratio of 16.55 while Google Search was being valued at maybe below 10. Let's look at another example. If we look at Lowe's, we can see they're being valued at a forward price to earnings ratio of 18.19. And if we look at the EPS growth projections for this company, it's sitting at just 5%. So what does this all mean? Those were two companies with very low growth projections over the next couple of years. Well, the main threat to Google, yes, is Google Search, but it's already only being valued at a multiple of about 10 times earnings. And in the midst of being valued at a very low multiple, much lower than a lot of companies that are growing earnings very slow, they were still able to grow their Google Search revenue 10% year over year. This is literally from an earnings report just a few weeks ago. What's ironic about this is that's the exact same earnings growth rate that we're seeing from the YouTube ads business. Not to mention, if we actually jump over to my balance sheet breakdown and come up here and plug in Google, what we can see is the company sitting on a huge cash position. In fact, total current assets is sitting at $162 billion, while total current liabilities is sitting at $91.6 billion. So they're obviously in a very strong cash position as well. That should be factored into the valuation. So near the end of the article, Barrons makes the argument that Alphabet could be worth about $260 per share, but what exactly would it take for them to get there? Well, we can easily back into this number using my PE/earnings sensitivity valuation. Let's come up here and plug in Google stock. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now again, we can back into the price target for this stock based on the projected earnings per share growth rate and the projected PE ratio in the future. So let's start by projecting the PE ratio by the year 2030. What we can see is the average PE ratio for Google over the last 10 years is about 29, but we do have a huge outlier here in 2017, so let's remove that outlier and it bumps down to about 25.88. Well, the trailing 12 months PE ratio was sitting at about 17.3. What the article stated is they expected this to get back to around 25 or 26. So let's plug that into our projected PE ratio. If we come over here and assume the low end of the projected EPS growth rates, because what we can see is with the ticker data estimates, the projected EPS CAGR over the next few years is about 14.22%. But if we go ahead and assume 10%, what we could see is it could hit Barron's price target by the year 2027. The share price would hit about $267 and you'd have a total return of 71% and a compounded annual return of about 20%. And based on these metrics as well, by the year 2030, the share price would be $356 with a total return of 128% and a compounded return of nearly 15%. But I do have to admit, I think these projections are a little more on the aggressive end, at least the projected PE ratio. I personally prefer to be quite a bit more conservative. So even with a much more conservative estimate, let's enter a projected PE ratio of just 20, we can still see the stock looks quite attractive from a valuation perspective. Through the year 2030, you could get a double-digit compounded annual return rate. So while this article might be slightly optimistic, I do think it does a phenomenal job breaking down just how undervalued Google search is when you break things out. Based on what we've seen today, I think the reality is that Google search really already has its worst case scenario priced into the stock. Because the YouTube business segment, the Google Cloud business segment, and the Waymo business segment all look very attractive right now. They're all growing at high rates, and in fact, if we look at Google Cloud revenue, it was up over 28% year over year. So yes, I do understand why some people have concerns about Google search losing some revenue due to the threat of AI, but breaking out the business segments, it becomes pretty clear this is completely priced into the stock already. I think some could even argue Google pretty much has its worst case scenario priced in. But go ahead and let me know what you think of Google stock in the comments down below if you plan on buying or selling. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.